You know, in the world of finance, some things move, and then some things really move. And lately, gold has been putting on a show for the ages. We're talking about a kind of volatility that has left even the most seasoned traders completely breathless. So let's just dive right into this absolutely wild ride.
So, just a few days ago, gold didn't just break its old records, it completely shattered them. It rocketed up to a spectacular, brand new, all-time high of $5,560 an ounce. I mean, it was this massive surge, and it felt like gold's rise was just unstoppable.
But then, the floor just fell out from under it. In a pretty shocking reversal, gold had one of its steepest single-day drops in history, plummeting all the way down to an intraday low of just over 47.40. That's a truly staggering move in such a short time.
Now that drop is a swing of over $800 an ounce from its peak. So the big question, the one we have to ask is, what on earth caused this epic faceplant? And maybe more importantly, what does it mean for where gold is headed next?
Okay, so here's where it gets really interesting. Despite all that chaos, the world's biggest financial institutions, they aren't just holding their ground, they're actually doubling down. Some of them are forecasting that gold is going to push well past the $5,000 mark. Now, I know that sounds completely contradictory, so let's unpack why they're still so optimistic.
The core argument is basically this: that recent plunge, as dramatic as it was, it's just noise. The bigger picture, according to these analysts, is that gold has entered what they're calling a structural bull cycle. And this isn't about short-term spikes, no. It's about these powerful, long-term trends that are fundamentally revaluing the metal itself.
And this quote really illustrates that thinking perfectly. JP Morgan's Natasha Kaneva puts it this way: the path up won't be a straight line. I think we just saw pretty dramatic proof of that. But the underlying forces pushing gold higher, they are still very, very much in play. So, what exactly are those forces?
Right, let's get into the first major pillar of this bull case: demand. And we're not talking about your average, everyday level of buying. We are seeing an absolutely unprecedented appetite for physical gold from some of the world's biggest players.
It's really the multi-trillion-dollar question, isn't it? If prices are being driven up by all this demand, who exactly is doing all the buying at these record levels?
Well, the answer really comes down to two main groups. First, you've got central banks, the big financial institutions that manage their country's currencies. And second, there's this massive wave of global investors, and they're piling into everything from gold ETFs to physical bars and coins.
Let's just zoom in on the central banks for a second, because their behavior has fundamentally changed. If you look at the period before 2022, they were buying a pretty steady amount each year. But in the last few years, that buying has more than doubled. This is not a blip. It is a major strategic shift.
And their motivation is pretty clear. It's all about de-dollarization. Central banks all around the world, especially in emerging markets, are actively trying to reduce how much they rely on the US dollar as their main reserve asset. For them, gold is the ultimate neutral currency, a really reliable store of value that's outside the control of any single government.
Okay, let's move on to the second major driver, and you'll see how this builds on the first: the actions of the US Federal Reserve. The Fed's policies on interest rates have a massive direct impact on how appealing gold is as an investment.
So, since late 2024, the Fed has been in what's called an easing cycle. This timeline kind of shows you how they've been steadily cutting interest rates, bringing them down quite a bit. And the forecast for 2026, well, it's for that trend to continue, with rates potentially dropping down toward 3%. This is a huge tailwind for gold. But why? Well, it comes down to two key ideas.
First up is something called currency debasement. Basically, when a central bank cuts interest rates and expands the money supply to help the economy, it risks watering down the purchasing power of its own currency. Investors see this happening, and they flock to gold as a hedge, as a way to protect their wealth from being devalued.
This second concept is opportunity cost, and this slide lays it out perfectly. See, gold doesn't pay you any interest. So when interest rates are high, holding gold is kind of expensive because you're missing out on the guaranteed return from something like a government bond. But when rates are low, like they are now, that opportunity cost of holding gold just collapses, making the non-yielding metal way more attractive in comparison.
Okay, so we've got these really powerful long-term forces pushing gold higher. Which of course brings us right back to our original mystery. If the outlook is so rosy, then what in the world explains that brutal $800 crash?
Well, the plunge wasn't caused by just one thing. It was really a perfect storm of short-term factors all hitting at once. First, the US dollar suddenly rallied, which makes gold more expensive for anyone buying with other currencies. Then you had some good news for markets. A compromise in Washington avoided a government shutdown, and a more traditional market-friendly candidate was nominated to lead the Fed. With less immediate risk, investors just felt less need for a safe haven. And on top of all of that, after such a huge run-up, a massive wave of traders simply decided it was time to cash in and take profits, which just created a cascade of selling.
So, what does this all mean when we put it all together? Well, it really seems like gold is caught in this fascinating tug-of-war between two very different stories.
At the end of the day, it boils down to this. On one side, you have these powerful structural forces, like central bank buying and low interest rates, pushing prices higher over the long term. But on the other side, you've got short-term market news and profit-taking that can cause these violent, sudden corrections. The future of gold really depends on which of these forces wins out.
And that leaves us with one final, fascinating question. For thousands of years, gold has been seen as the ultimate store of value. But as we navigate a world of unprecedented government debt, brand new digital currencies, and all this geopolitical uncertainty, what role will this ancient metal really play? What is its true value in the 21st century? That is the mystery that markets are trying to solve right now.